All right, you know that feeling, right? That little shiver down your spine when tax season rolls around,
Yeah.
and you find yourself just staring blankly at a form that looks like it was written in, I don't know, Klingon?
Huh. Yeah, or maybe just legalese, which is almost the same thing sometimes.
Exactly. Like a bunch of numbers and acronyms just float there, kind of mocking you, especially if you're trying to figure out what to do with, say, a rental property or maybe a side hustle you've got going on.
Or even an investment that, well, didn't quite pan out the way you hoped.
Right. You've got losses. You know they should be deductible somehow, but
Sure.
how? And, how do you make sure you're not leaving money on the table? That's always the worry.
Absolutely. It's complex territory.
Well, today we're doing a deep dive into something that might seem incredibly dense at first glance, but it holds real power for your tax return. We're talking about passive activity loss limitations, or BILs. We're especially focusing on how they apply to you and maybe some clever ways to navigate them for potential tax savings. Our mission today: to demystify Form 8582, we want to pull out those critical insights that can actually make a difference.
Yeah, unlock some of that complexity.
And to help us extract those, valuable nuggets from the often intimidating IRS instructions for Form 8582, we have our expert guide joining us.
Happy to be here. And it's so crucial to get a handle on these rules. Because, look, whether you're dealing with just one rental property, maybe a side business where you're not super involved day to day,
Right.
or maybe you're trying to figure out how to finally claim those losses from prior years that have just been sitting there,
Uh-huh.
these rules directly impact your bottom line. Understanding these limitations isn't just about, ticking boxes for compliance. It's really about making sure you're optimizing your tax situation, maximizing your deductions, and truly not leaving any of your hard-earned money on the table.
Optimize. I like that word.
Exactly. This deep dive should hopefully arm you with the knowledge to actively manage your tax position, not just react to it.
Okay, so let's start with the basics. What exactly is a passive activity loss? I mean, the IRS instructions for Form 8582, they give us a definition, right? It says, uh, a passive activity loss, PAL, occurs when total losses, including prior year unallowed losses, from all your passive activities exceed the total income from all your passive activities.
Pretty straightforward, yeah. Losses are bigger than income in that bucket.
Simple enough. But what generally counts as a passive activity, beyond just the loss part? Like, what kind of activities fall into this passive bucket?
That's where the details start to matter, and honestly, where a lot of folks get tripped up right at the beginning.
Mm-hmm.
Generally, a passive activity falls into one of, let's say, two main categories.
Okay.
The first one is any trade or business activity where you did not materially participate for the tax year.
Materially participate. Okay, we'll need to unpack that later.
Definitely. But think of it like this. If you're investing in a business, maybe you're a silent partner, or you own a piece of a startup, but you're not really involved in running it day to day or making the big decisions, that's likely going to be passive.
Got it. Hands-off involvement.
Exactly. Now, the second category, and this is a really key distinction, it catches a lot of people. All rental activities are generally considered passive, period, regardless of how much time you spend on them.
Wait, really? Regardless of participation?
That's the default rule.
Mm-hmm.
Now, there are some very specific, kind of narrow exceptions we'll definitely get into later, but if you own a rental property, it could be a house, a condo, multi-unit, even a vacation rental, it's income and losses. They generally start in the passive bucket right off the bat.
Wow. Okay, so even if I feel like I'm working hard on my rental, screening tenants, fixing things, the IRS basically says, nope, probably passive.
That's the starting presumption, yeah. You
Yeah.
have to actively prove you fit into one of the exceptions to get out of that passive classification for rentals.
Okay, let's unpack this a bit more then. It sounds like the IRS is really focused on how involved you are, or maybe aren't, in making money from a specific thing, right? The less involved, or if it's a rental, the more likely it's passive for tax purposes. But why? Why does the IRS care so much about this? Why not just let losses offset gains from wherever they come from? Seems simpler.
It would seem simpler, wouldn't it? But
Yeah.
you've hit the core issue. And what's really fascinating here, the whole reason these rules exist, is this core limitation. PLs, those passive activity losses, generally cannot be used to offset income from non-passive activities.
Ah, okay. There's the wall.
That's the wall. And it's a critical point that trips up so many taxpayers because naturally you assume a loss from, say, your rental property should reduce the tax you owe on your salary from your main job.
Yeah, exactly. A loss is a loss.
But the IRS says, generally, no. Think of it like different buckets of money, like you hinted at earlier.
Yeah.
You've got your active income bucket, that's your salary, your wages, maybe profits from a business where you do materially participate. Then you have your portfolio income bucket, think interest, dividends, capital gains from stocks and bonds.
Right, investments.
And then you have this separate passive activity bucket, that's income or loss from activities where you don't materially participate,
Yeah.
or from those rental properties we just talked about.
3 buckets. Got it.
The general rule is you can only net income and losses within that passive bucket. If your passive losses are more than your passive income for the year, those extra losses are generally stuck. They get suspended, carried forward to future years.
Suspended.
But you can't just reach into that passive bucket and pour those losses into your active job income bucket to
No.
lower your overall taxable income. Not usually, anyway. There are exceptions, but that's the fundamental barrier.
That's a really helpful analogy, keeping them in separate, kind of isolated systems. But why? What's the history here? Why did the IRS put up these walls in the first place? Feels like a strategic move.
Oh, it absolutely was strategic.
Yeah.
These pale rules, they came about primarily with the big Tax Reform Act of 1986. And the main goal back then was to shut down what were known as tax shelters.
Ah, okay. Heard of those.
Yeah. These are often schemes where, high-income individuals would invest in activities specifically designed to generate big, sometimes artificial, losses on paper.
Mm-hmm.
And then they'd use those paper losses to wipe out the taxes they owed on their salaries or professional practice income or other profitable businesses. The IRS really wanted to clamp down on that to make sure deductions were tied to actual economic activity and risk, not just manufactured for tax avoidance.
Okay, so it was about fairness and preventing gaming the system.
Pretty much. Ensuring losses weren't just arbitrarily used solely to slash tax bills.
Mm-hmm.
So to help regular taxpayers, individuals, estates, trusts, navigate these rules and comply, they created Form 8582.
The form itself.
Right. Its official purpose is to figure the amount of any passive activity loss, PAL, for the current tax year, and to report the application of prior year unallowed PLs.
Mm-hmm.
It's basically your worksheet, your guide to applying these limitations correctly.
Okay, so that clears up the what and the why of PLs. Now, who has to file this form? And more importantly, maybe, is there a way to avoid it? Because, let's be honest, fewer forms, less complexity, that usually means more peace of mind.
Absolutely. And maybe more direct tax savings, too.
Exactly.
You're right. Less interaction with complex forms is usually a win.
Yeah.
Generally speaking, individuals, estates, and trusts who have passive activity deductions, and that includes those prior year unallowed losses we mentioned, the suspended ones, they must file Form 8582.
Okay, so if you have passive deductions, you probably need the form.
But, and here's where it gets really interesting, like you were hoping.
Mm-hmm.
There is an exception, a potential golden ticket, if you will, that lets you avoid filing Form 8582 entirely.
Ooh, tell me more.
If you meet a specific set of conditions, there are 7 of them. Your rental real estate losses might not be limited by these rules at all, and you just report them directly on, say, Schedule E, no Form 8582 needed.
7 conditions. Okay, that sounds like a hoop to jump through, but maybe worth it.
Definitely worth checking if you qualify, because it's a huge simplification and a direct tax benefit. Let's break down these 7 conditions. Meeting all of them can save you a ton of headache and potentially unlock your losses right away.
Okay, lay 'em on me.
First, you must have actively participated in your rental real estate activities. We'll dig into what active participation means soon, but just know for now it's a lower bar than material participation. Think making key management decisions.
Okay, active participation. Got it. Number 1.
Second, these actively participated rental real estate activities must have been your only passive activities.
Only. So no other side businesses that are passive.
Correct. If you have a rental and you're a silent partner in a restaurant, for instance, you're out. This exception doesn't apply. It has to be just the rental real estate.
Right. Okay, only passive activity. Number 2.
Third, you have to have no prior year unallowed losses hanging around from any passive activity, rental or otherwise. If you have suspended losses from previous years, you need Form 8582 to track them. This exception is for a clean slate, essentially.
No carryover losses. Check. Number 3.
Fourth, your total loss from these rental real estate activities for the year must not be more than $25,000.
Ah, a dollar limit.
Yep. And if you're married filing separately, that limit drops to $12,500. So if your rental loss is, say, $30,000, boom, you don't qualify for this exception.
25K max loss, $12 5K MFS. Number 4.
Fifth, a specific one for married filing separately. You must have lived apart from your spouse for the entire year.
Okay, lived apart all year of MFS. Number 5.
Sixth, you must have no current or prior year unallowed credits from any passive activity. Passive activity credits also have their own limitations. If you have any suspended credits, this exception is off the table.
No passive credits either. Okay. Number 6.
And finally, number 7, your modified adjusted gross income, or MGI, must be not more than $100,000.
MGI again. Okay.
Yep. And if married filing separately, that threshold is $50,000. We'll get into MGI specifics later, but it's a hard ceiling for this particular exception. Oh, and one more thing tied to this. You can't hold your interest in the rental real estate as a limited partner or as a beneficiary of an estate or trust. Those ownership types automatically disqualify you from this exception.
Okay. MAGI under 100K, 50K MFS, and not a limited partner beneficiary. Number 7. Wow, that's a list.
It is. But think about what it means.
Yeah, so what does this all mean for you, our listener? This is actually a really important insight. If your rental situation is pretty straightforward, right? If you're actively involved in managing it, your income and losses are within these limits. You basically get a free pass from this complex Form 8582. Your rental losses aren't limited by the passive rules at all. You just report them directly on Schedule E. That's a huge simplification. Fewer forms, less headache, and a direct, immediate tax benefit because your losses aren't suspended. It's like the IRS saying, hey, you kept it simple, here's your shortcut.
That's a good way to put it. It's a fantastic example of a direct tax-saving strategy built right into the rules for simpler rental situations. So building on that idea of direct tax benefits, let's talk strategy. The first major strategic play to avoid the passive loss limitations entirely is to materially participate in a trade or business activity.
Ah, back to material participation.
Right. If you meet the standard for material participation in a trade or business, then that activity is simply not passive. It's considered active.
And why is that such a big deal?
Because if it's non-passive, its losses can generally offset any of your other income, your W-2 salary, your investment income, whatever. This is huge for small business owners, freelancers, people starting new ventures, especially in those early years when you might have losses.
Okay, that sounds like the holy grail for a lot of side hustles or startups, but material participation, how do you actually prove that? It can't just be like showing up once a week or checking emails, right? There has to be some real substance. What are the actual rules?
You're spot on.
Yeah.
It requires genuine, substantial engagement. The IRS actually gives us 7 specific tests for individuals to figure out if they materially participated. And here's a key insight. You only need to meet one of these 7 tests for the tax year.
Just one?
Okay, just one. Meet one test. And that activity is non-passive. Its losses can potentially offset your other income, which is a massive tax saving. This is where, honestly, keeping good records and thinking strategically about how you spend your time in the business becomes critical.
All right, let's break down these 7 tests. What are they and what do they mean practically?
Okay, test number 1, more than 500 hours. This is the most straightforward. If you spent more than 500 hours working in the activity during the tax year, you materially participated.
500 hours, that's about 10 hours a week, roughly.
Yeah, it's a significant chunk of time, especially for a side business. The strategic implication, track your time. If you're putting in the hours, document it. Appointment books, calendars, detailed time logs, even narrative summaries of what you did, emails, meetings, project work. It can all be crucial evidence.
Okay, so keep records. That's test 1.
Test number 2, substantially all participation. This one applies if your work was basically all the participation in that activity by anyone, including non-owners or employees.
So if I'm a true solo operator, doing pretty much everything myself.
Exactly. A solo consultant, a freelance artist, maybe a really small shop where you're the only one really running things day to day. If you do almost all the work, you meet this test. It acknowledges you're the primary engine.
Got it. Test 3.
Test number 3, more than 100 hours A&D, at least as much as any other individual. So for this one, you need to work more than 100 hours in the year, and your participation has to be equal to or more than anyone else involved, including non-owners.
Okay, so maybe not 500 hours, but still the main person involved.
Right. Think of a small partnership. Maybe you put in 150 hours and your partner puts in 80. You'd meet this test because you're over 100 hours and you worked more than your partner. It's crucial for smaller operations where maybe no single person hits 500 hours, but there's clearly a lead participant.
Okay, that makes sense. What's number 4?
Number 4 gets interesting. Significant participation activities, SPA. This is for the person juggling multiple things. It applies if the activity itself is a significant participation activity, and your total time across all your SPAs adds up to more than 500 hours for the year.
Whoa, okay. What's a significant participation activity?
An SPA is any trade or business activity where you participated for more than 100 hours, but you didn't meet any of the other material participation tests, like the 500-hour test or the substantially all test, for that specific activity on its own.
So I could have 3 side businesses, spend 150 hours on each.
Exactly. None of them hit 500 hours alone. None might meet the more than anyone else's test.
Yeah.
But you spent more than 100 hours on each. You add them up. 150 plus 150 plus 150 equals 450 hours. Okay, that doesn't quite hit 500. Let's say it was 180 hours each.
Okay, 180 by 3 equals 540 hours.
Right. 540 hours total across your 3 SPAs. Because the total is over 500, all 3 of those activities are now treated as activities where you materially participated.
Wow. That's powerful for people with multiple related side gigs.
It really is. It recognizes that significant time commitment can be spread out. Okay, test number 5. 5 of the 10 preceding tax years. If you materially participated in the activity using any of the tests for any 5 of the 10 tax years immediately before the current year, you're considered to materially participate this year too. It doesn't have to be consecutive years.
So for established businesses where maybe my involvement dipped this specific year.
Precisely. It's a look-back test for consistency. It recognizes long-term commitment, even if one year is different.
Okay, number 6.
Test number 6. Personal service activity, 3 preceding tax years. This is similar, but specific. If the activity is a personal service activity, and you materially participated in it for any 3 preceding tax years, again, consecutive or not, you meet the test this year.
What counts as a personal service activity?
Think fields like health, law, engineering, architecture, accounting, actuarial science, performing arts, consulting. Basically, professions where the income comes mainly from your personal skills and efforts, and where capital isn't a major income-producing factor.
So like a doctor or a lawyer who's been practicing for years.
Exactly. They'd likely meet this test even if their billable hours dropped in one specific year because of their history in that personal service activity.
Okay, makes sense. And the last one, number 7.
Test number 7, facts and circumstances. This is the catch-all, but it's often the trickiest to rely on. It says, based on all the facts and circumstances, your participation was regular, continuous, and substantial during the year. However, there are big caveats. First, you must have participated for more than 100 hours. If it's 100 hours or less, you automatically fail this test. Second, your management activities don't count towards this test if someone else was paid to manage the activity, or if someone else spent more hours managing the activity than you did.
So it's hard to use if you're just doing high-level management and someone else runs the day-to-day.
Very hard. It's generally tougher to prove and more likely to be challenged by the IRS unless your documentation is absolutely rock solid and it clearly shows substantial ongoing involvement beyond just basic oversight.
Wow. Okay, that breakdown of the 7 tests is incredibly helpful. It's really detailed and gives you concrete things to aim for and document. And just meeting one, that loss goes from passive and stuck to non-passive and potentially fully deductible against your other income.
Exactly.
That is a direct, significant tax-saving strategy for so many small business owners, freelancers, people with side hustles, especially in those tough early years. Anything else folks should keep in mind about participation?
Yeah, a couple of quick points. First, your spouse's participation can count as your participation for these tests, even if your spouse doesn't actually own any part of the business. That's often helpful for family-run businesses.
Good tip for couples.
Second, just being an investor usually isn't enough. Work done just reviewing financial statements, preparing analyses for your own use, or generally monitoring things in a non-managerial capacity. That typically doesn't count as material participation. You need hands-on involvement in operations or management.
Okay.
And third, a heads up for limited partners. You're generally presumed not to materially participate. You usually only overcome that presumption if you meet test 1, over 500 hours, test 5, 5 of 10 prior years, or test 6, personal service activity, 3 prior years. It's a higher bar for LPs.
Got it. Okay, so that covers how to make a trade or business non-passive. Now let's swing back to rentals. You said they're generally passive by default,
Right.
but there was an exception you mentioned, something about being a real estate professional.
Ah, yes, the real estate professional exception. This is a big one, but it's tough to qualify for. While rentals are usually passive, the rule says you can treat a rental real estate activity as not passive if you are a real estate professional for the tax year.
Okay, that sounds potentially huge. What does it actually take to qualify? I'm guessing it's more than just owning a rental or two on the side. Sounds like it has to be your main gig.
You've got the right intuition. It's quite strict and really designed for people whose primary work is real estate. You have to meet both of two tough tests, not just one.
Wait, both tests. What are they?
Test number one. More than half of the total personal services you perform in all your trades or businesses during the year must be in real property trades or businesses where you materially participate.
More than half your work time.
Yep. So if you have a full-time W-2 job completely unrelated to real estate, it's going to be extremely difficult, if not impossible, to meet this test. Your real estate work has to be your dominant professional activity in terms of time spent.
Okay, that's a high bar. What's the second test?
Test number two. You must perform more than 750 hours of services during the tax year in those real property trades or businesses where you materially participated.
750 hours on top of the more than half your time rule.
Exactly. 750 hours is significant. That's over 15 hours a week every single week of the year, dedicated just to your materially participated real estate activities. And again, you need meticulous records to prove both the hours and the material participation in those activities.
Wow, okay. And what about married couples? Can they combine hours?
Good question, and the answer is generally no for qualifying as a real estate professional. For joint filers, one spouse must separately meet both tests, the more than half test and the 750-hour test. You can't add your hours together to get one spouse over the line. One individual has to clear both hurdles on their own.
That's really strict. What counts as a real property trade or business for these tests?
It's fairly broad within the industry. Includes things like real property development, redevelopment, construction, reconstruction, acquisition, conversion, rental, operation, management, leasing, or brokerage. So a wide range of real estate activities qualify, but you have to meet those participation hurdles within them.
Okay. So, bottom line. If you are a full-time landlord with a big portfolio, or maybe a developer or a busy property manager, and real estate is genuinely your primary job, this could be your golden ticket.
Absolutely.
It lets you potentially deduct those rental losses directly against your ordinary income, bypassing the passive loss limitations entirely. That could unlock huge tax savings, potentially tens or even hundreds of thousands of dollars over time for the right person.
It's a game changer for those who qualify, no doubt. And just quickly, for completeness, there are a couple of other niche activities the IRS says are not passive. One is owning a working interest in an oil or gas well, but only if you hold it directly and your liability isn't limited. Like, you're personally on the hook if something goes wrong. If it's through an LLC or limited partnership, it's usually passive.
Okay, specific.
Another is the rental of a dwelling unit that you also use significantly as a personal residence during the year generally, more than 14 days or 10% of the rental days. In that case, different rules under Section 280A apply, limiting losses mainly to rental income, but it's technically not a passive activity under these rules.
Got it. Personal use complicates things differently.
And finally, certain trading activities like active stock trading where you don't materially participate have their own special rules. They generally can't be grouped with other activities and aren't treated as passive activities entered on Form 8582 anymore, especially after changes made around March 2021. It's a separate category.
Okay, good to know those edge cases exist. Now, even if you don't qualify as that high bar real estate professional, maybe you have a demanding day job, which is probably true for many listeners.
Right, very common scenario.
Is there still any break for rental property losses? You mentioned something earlier about active participation being different.
Yes, absolutely. This is a really important one for many average rental property owners. Even if you're not a real estate pro, there's another valuable allowance called the special allowance, specifically for rental real estate, provided you actively participate.
Okay, special allowance via active participation. Sounds promising. How does it work?
It's definitely a valuable middle ground.
Yeah.
This active participation standard is significantly less strict than material participation. You don't need 500 hours or anything like that.
Easier to meet. Good.
Much easier. If you actively participated, you might be able to deduct up to $25,000 of loss from that rental activity directly against your non-passive income, like your salary or investment income.
Up to $25,000. That's pretty substantial.
It can make a big difference. It's a direct exception carved out from the general rule that blocks passive losses from offsetting other income. It provides a crucial tax-saving path for many individuals. This allowance is generally available to individuals, qualifying estates, and certain trusts. But, quick note, limited partners usually can't claim this, as they're typically not seen as actively participating.
Okay, so what does active participation actually mean then? How is it different from material participation? Can you give some concrete examples? Because this distinction feels really key for a lot of landlords.
Great question. The key difference is that active participation doesn't require that heavy day-to-day, hands-on involvement. You can be treated as actively participating if, for example, you make significant management decisions in a real bona fide sense. Even if you hire others, like a property manager or repair people, to handle the daily stuff.
So it's more about being the boss, making the key calls.
Exactly. It's about involvement in the strategic decisions, not necessarily swinging the hammer yourself or fielding every late-night tenant call.
Okay, like what kind of decisions?
Well, the IRS guidance gives examples like approving new tenants. You have final say on who rents your property, deciding on rental terms. You set the rent amount, lease length, security deposit rules, etc., approving capital expenditures or significant repairs. You decide whether to do that big roof replacement or approve a major appliance purchase. You authorize the spending, even if you hire someone else to do the work.
Okay.
It also includes things like reviewing financial reports, making decisions about property improvements, or even just hiring and firing the property manager. As long as you retain that decision-making power and exercise it, you likely meet the active participation standard. You don't have to be involved in the mundane tasks like collecting rent or scheduling minor repairs if you have someone else doing that,
Yeah.
provided you're still making the important calls.
That's a huge clarification, especially for listeners who use property managers. So you can still actively participate even if you hire help, as long as you're not completely hands-off.
Precisely. Strategic oversight is the key.
Okay, but I feel a but coming. I know there's often a catch with these allowances. You mentioned MGI earlier. Does that $25,000 allowance depend on your income?
Ah, yes, the inevitable but. You're right. This allowance isn't unlimited, and your ability to claim the full $25,000 depends heavily on your modified adjusted gross income, or MGI.
Okay, here we go. MGI.
It's specifically designed to phase out as your income goes up, ensuring it primarily benefits moderate income taxpayers.
So what are the thresholds? How does the phase out work?
All right, here are the MGI levels you need to know. If your MGI is $100,000 or less, or $50,000 or less if you're married filing separately, congratulations. You generally qualify for the full special allowance, up to that $25,000 maximum loss deduction, or $12,500 if MFS.
Okay, under 100K, 50K MFS, you get the full potential benefit.
Right. But if your MGI is more than $100,000 or $50,000 MFS, but less than $150,000 or $75,000 MFS, the allowance starts to phase out.
How does the phase out calculate?
It's reduced by 50% of the amount your MGI exceeds $100,000 or $50,000 MFS. So for every dollar your MGI is over $100,000, your potential $25,000 allowance gets cut by 50 cents.
Can you give an example?
Sure. Let's say your MGI is $120,000. That's $20,000 over the $100,000 threshold. Your allowance is reduced by 50% of that $20,000, which is $10,000. So instead of getting up to $25,000, the maximum special allowance you could claim is $15,000. $25,000 minus the $10,000 reduction.
Okay, so it ramps down pretty quickly in that 100K to 150K range.
It does. And then generally, if your MVI is $150,000 or more, or $75,000 or more if MFS, the special allowance is completely phased out. You get zero benefit from it at that income level.
Wow. Okay, so that 150K, 75K MFS is a hard cutoff for the special allowance. Now, what exactly goes into calculating this specific MGI? Because you mentioned it's modified adjusted gross income. It's not just my AGI off the front page of my 1040.
Right. Excellent question. Because you're right. It's a specific calculation, and getting it right is crucial. You basically start with your regular adjusted gross income, AGI, from your Form 1040, and then you make several specific adjustments just for this calculation.
Okay, what gets added back or ignored?
First, you don't subtract the very passive activity laws you're trying to calculate the allowance for. That would be circular reasoning.
Makes sense.
You also don't include any rental real estate loss that was allowed because the taxpayer qualified as a real estate professional. That's treated differently.
Okay.
Then, you generally need to add back several deductions that might have lowered your AGI. Things like taxable Social Security benefits, deductible contributions to traditional IRAs, the deductible part of self-employment taxes, the student loan interest deduction, certain education-related exclusions, like the one for tuition and fees. The foreign-derived intangible income deduction is also excluded from the calculation. The idea is to get a measure of income before some of these specific tax breaks.
Adding things back. Okay, what else?
Crucially, you do include portfolio income, things like interest, dividends, non-passive capital gains, and any expenses directly tied to that portfolio income. So your investment earnings are fully counted here.
So investments count towards phasing you out.
Yes. And one more potentially significant item, you also must include any overall loss you had from an entire disposition of a different passive activity in that year.
Wow, that MGI calculation is pretty specific. A lot of things moving in and out.
It really is. And it shows how being right near one of those thresholds, $100,000 or $150,000, means that even small changes elsewhere on your return, like realizing a capital gain, could potentially reduce or even eliminate this valuable $25,000 rental loss allowance.
Yeah, this is a fantastic example of where understanding the nitty-gritty definitions, like this specific MGI, can directly impact your tax outcome and savings. It's complex, but knowing it is key for anyone with rental properties, especially if they're near those income phase-outs.
Okay, let's shift gears a bit and talk about another strategic element. How you organize or group your activities for tax purposes. This can really simplify things and affect how the passive loss rules apply. The rules allow you to choose to treat one or more trade or business activities or rental activities as a single larger activity if they form what's called an appropriate economic unit.
Grouping activities. So like if I have three little related businesses, instead of tracking participation for each one separately.
Exactly. Instead of needing, say, 500 hours in each one to meet the material participation test, you might group them together. If the group as a whole meets the test, like if your total time across all three exceeds 500 hours, then the entire group can be treated as non-passive.
I see. Like the SPA example you gave earlier, but maybe even for activities that aren't technically SPAs.
Right. Let's say you own 3 coffee shops in the same city. You manage them all, maybe share some suppliers, have similar branding. Individually, maybe you only spend 200 hours on each. But if you group them into a single coffee shop activity, your total participation is 600 hours. Boom, the whole group likely meets the material participation test, and any losses could become non-passive.
That sounds like a really powerful tool, especially for entrepreneurs with several related ventures. How do you determine if grouping is allowed? What makes an appropriate economic unit?
It depends on all the facts and circumstances, but the IRS highlights 5 main factors they look at. 1, similarities and differences in the types of businesses. Are they in the same industry or related fields? 2, the extent of common control. Do you basically call the shots for all of them? 3, the extent of common ownership. Do you and maybe the same partners own similar stakes in each? 4, geographical location. Are they physically close or maybe serve the same regional or online market? 5, and interdependencies between them. Does one business supply another? Do they share customers, employees, or facilities?
Okay, those factors make sense. It's about genuine economic ties.
Exactly. And the rules offer some flexibility. The IRS gives an example. Say you own a bakery and a movie theater in Baltimore and another bakery and movie theater in Philadelphia. You might, depending on the facts, group them all together as one big activity. Or maybe group the 2 bakeries together and the 2 theaters together by type. Or group the Baltimore businesses together and the Philly businesses together by geography. Or even keep all 4 separate.
So you have some choices based on what makes the most economic sense.
You do. But once you choose a grouping, you generally have to stick with it in future years.
Consistency matters.
Yes, unless the original grouping was clearly wrong from the start, or the facts and circumstances changed so much that the old grouping just doesn't make sense anymore. Also, the IRS reserves the right to regroup your activities if they think your chosen grouping doesn't reflect an appropriate economic unit and looks like it was done primarily just to get around the passive loss rules.
Okay, so you can't just gerrymander your activities purely for tax avoidance. It needs a real economic basis. Are there things you absolutely can't group together, even if they seem related?
Yes, there are some hard and fast restrictions to prevent potential abuse. You generally cannot group a rental activity with a trade or business activity. They're fundamentally different under PIL rules. The only tiny exceptions are if one is really insubstantial compared to the other, or if the ownership structure is identical across both. This stops people from using typically passive rental losses to offset active business income through grouping.
Okay, keep rentals separate from businesses.
You also generally can't group the rental of real property, like a building, with the rental of personal property, like equipment, unless the personal property is provided in connection with the real property, like renting furniture with an apartment. There are also specific limits on grouping activities involving limited partner interests, especially in fields like film, farming, or oil and gas. Those are often seen as inherently more passive investments. And as we mentioned briefly before, those trading activities where you don't materially participate, they absolutely cannot be grouped with any other activity, not even other trading activities. That's a firm line, especially since 2021.
Got it. So, some definite guardrails on grouping. Now, I heard something about a special regrouping chance related to the net investment income tax, or NIIT, like a fresh start.
Yes, it's a very specific but potentially powerful opportunity. The NIE is that extra 3.8% tax on investment income for higher income taxpayers, generally those with MBI over $200K single or $250K married filing jointly. If you become subject to the NIT for the first time, the rules allow a one-time NIT fresh start election. This lets you completely regroup your activities once. In that first year, you're subject to NIT.
A one-time do-over for grouping? Why would someone do that?
Well, how you group your activities can actually affect how much income is subject to the NIT. For example, regrouping might help you meet a material participation test for a larger group, which could potentially reclassify some income from passive, potentially subject to NIT, to non-passive, potentially not subject to NIT. It's a chance to optimize your grouping specifically with that 3.8% tax in mind.
Ah, okay. A strategic regrouping to minimize NIIT, that makes sense.
It's a niche rule, but valuable if it applies to you. If you do regroup, either under the NIT election or just making a regular grouping choice, you generally need to file a statement with your tax return. It needs to explain the grouping, list the activities involved, names, addresses, EANs, and declare that they form an appropriate economic unit. Disclosure is important.
Okay. Now let's talk about the suspended losses again. The ones that get carried forward because you couldn't deduct them in a prior year. What happens to them? Do they just disappear eventually?
No, absolutely not. And this is why tracking them meticulously is so important for future tax savings. Those prior year unallowed losses, the PL carryforwards, they stick around indefinitely. They don't expire.
Indefinitely. Okay. So how do you finally get to use them?
They get released or allowed under a few circumstances. One, you can use them to offset passive activity income in a future year. If you finally have a year where your total passive income is more than your total passive losses, including current year ones, you can use the carry forward losses to soak up that passive income. Two, they might be deductible against the $25,000 special allowance for rental real estate, if applicable, in a future year.
Yeah.
Three, and the big one we touched on, they're generally released in full when you sell or otherwise dispose of your entire interest in that specific passive activity in a fully taxable transaction to an unrelated party.
The entire disposition trigger.
Right. That's often the primary way people finally get to deduct years of accumulated passive losses. Knowing how much loss is tied to each specific activity is crucial for maximizing that deduction when you eventually sell. Those carry forwards can represent significant future tax savings just waiting to be unlocked.
Okay, let's really focus on this release valve then.
Yeah.
The disposition of an entire interest. You're saying if I sell my entire stake in a passive activity, like sell the whole rental property or my entire partnership interest
To an unrelated person, yes.
in a fully taxable transaction,
Meaning you recognize all the gain or loss, like a normal sale, not a gift or tax-free exchange.
then all the losses tied to that activity, the current year loss, and all those suspended prior year losses, they're just released, unfrozen.
Exactly. They are released from the passive activity limitations in that year. They're no longer considered passive losses.
And what does that mean? Where can I use those released losses?
This is the magic part. Once released, those losses can offset any type of income you have.
Any type, like my regular salary.
Yep. Your W-2 wages, income from an active business you run, portfolio income like capital gains from stocks, interest dividends, anything.
Wow, that's huge.
It really is. Let's use that example again. Say you have that rental property with $75,000 in accumulated suspended passive losses over the years.
Okay.
You sell the entire property this year in a normal taxable sale to someone you're not related to. In this year, that entire $75,000 loss is released. You can use it to directly reduce your taxable income from your job or offset gains from selling stock, whatever. It can create a massive reduction in your tax liability for the year of sale.
So strategically timing the sale of a passive activity with accumulated losses could be a major tax planning move, especially maybe in a high-income year.
Absolutely. It highlights that a loss on paper for many years can actually translate into a very significant tax saving when you finally dispose of the activity correctly. It underscores why tracking those suspended losses per activity is so vital. Oh, and even if you use the installment method for the sale, you can still figure the portion of the loss allowed each year based on the gain recognized that year.
This is a key tax planning point, absolutely. The way and when you exit an activity with payout carryforwards can dramatically impact your taxes for that year. It's not just about managing the activity, but planning the exit. But what if I only sell part of the activity? Like maybe I own two rental condos grouped as one activity and I sell just one.
Crucial distinction.
Yeah.
If you dispose of less than an entire interest in a passive activity, the rules are different. Any gain or loss from that partial sale is just treated as part of the overall net income or loss from that activity for the current year.
Okay.
But importantly, that partial disposition does not trigger the release of any prior year unallowed losses.
So selling off half the activity doesn't unlock those old suspended losses.
Correct. They remain suspended, still tied to the portion of the activity you continue to hold. They only get fully released when you dispose of the entire interest that constituted the activity.
Okay, that's a really important difference. Entire disposition is the key for releasing old losses. Now, what about those publicly traded partnerships, PTPs? You mentioned they're different. How do PL rules work for them?
Yeah, PTPs are definitely their own animal under these rules. They can cause confusion because they trade like stocks, but they're often generating passive income or loss. The main thing to know is the passive activity limitations are applied separately for each PTP you own.
Separately for each one, meaning?
Meaning losses from PTPA can generally only be used to offset income from that same specific PTPA. You can't use losses from PTPA to offset income from PTPB or income from your rental property or your salary.
So each PTP is like its own little silo for passive losses.
Exactly. The losses are effectively trapped within that specific PTP investment until either that PTP generates enough passive income to absorb them or you dispose of your entire interest in that PTP.
Okay, so that $25,000 special allowance for rental real estate we talked about, that doesn't apply to losses from a PTP.
Correct. The special allowance is specifically not applicable to PLs from a PTP.
Wow. Okay. So how does it work if I have income or loss from a PTP?
You basically net everything for that specific PTP, current year income loss, gains losses, and any prior year unallowed losses carried forward just for that PTP.
Yeah.
If you have an overall gain from that PTP for the year, that net gain is actually treated as non-passive income. You report it, usually based on the K-1 form the PTP sends you, and it might get factored into other calculations like MGI for the special allowance for your other rentals or investment income. You typically mark it from PTP on your return.
Okay. Gain is non-passive. What if I have a loss?
If you have an overall loss from the PTP and you didn't sell your entire interest, that loss is only allowed to the extent you had passive income from that same PTP in the current year. Any excess loss. It gets suspended and carried forward, but again, only usable against future income from that specific PTP.
Still trapped in that silo.
Right, but if you have an overall loss, and you did dispose of your entire interest in that PTP to an unrelated party in a fully taxable transaction, then, just like other passive activities, the release valve opens. All your current and prior year unallowed losses from that PTP are allowed in full in that year. They can offset any other income.
Okay, so the entire disposition rule still works for PTPs eventually.
Yes, that's the main way out for accumulated PTP losses.
Okay, we've covered a ton, the rules, the exceptions, the strategies like participation, grouping, disposition. Now let's bring it back to the actual paperwork, Form 8582. How does it actually work when you sit down to fill it out? We don't need a painful line by line, but what's the logical flow? How does it guide you through all these calculations we've talked about? Understanding the mechanics feels crucial to actually getting those tax savings right.
That's a perfect way to wrap things up, because Form 8582 really is the central hub where all these rules come together. Think of it as a structured process. Its main job is to help you. 1. Consolidate all your passive income and losses. 2. Figure out how much loss is limited based on the rules, passive income limits, MAGI limits for the special allowance. 3. Calculate any special allowances you qualify for. 4. And finally, tell you exactly which losses you can deduct this year and which specific losses get carried over to next year. It's basically a big calculation and allocation worksheet.
Combining, calculating, allocating. Okay, so what are the main sections or parts doing? What's the flow?
Well, conceptually, it starts by gathering information. You need to categorize your different passive activities first. This happens across several parts or worksheets that feed into the main calculations. You typically separate things into rental real estate activities where you actively participated. These are potentially eligible for the special $25,000 allowance. This corresponds roughly to Part 4 of the form structure. A key point here. Prior year losses only go here if you actively participated both in the year the loss happened and in the current year.
Okay. Actively participated rentals go in one bucket.
All other passive activities. This is a broader bucket covering things like passive trade or business activities where you didn't materially participate, rental real estate where you didn't actively participate or where your income was too high for the special allowance. Other rentals, like equipment rentals, that are passive. This corresponds roughly to Part V of the form structure. Getting this initial categorization right is step one. You list the income, current year loss, and prior year suspended loss for each activity in the correct category.
Okay, categorize first. Then what?
Then, the form usually moves to Part 1. This part essentially sums everything up. It combines the totals from those categories, like Parts 4's V, to see if you have an overall net passive loss or net passive income for the year across all your activities. If you actually have overall net passive income, you might not even need to do much more on Form 8582, as your losses are generally allowed up to the amount of your income.
Okay, Part 1 is the grand total. Do I have an overall loss?
Exactly. If you do have an overall loss, then you move on to calculate the limitations. A key section here is Part 2, which is specifically designed to calculate that special allowance for the actively participated rental real estate activities from Part 4. This is where your NGI comes into play, figuring out how much, if any, of that potential $25,000 allowance you actually get based on the phase-out rules.
Okay, Part 2 figures the $25K allowance considering MNGI.
Right. Then Part 3 brings it all together. It takes your total passive losses, considers the special allowance you just calculated, and determines the total amount of passive losses allowed for the current tax year. This is your final allowed loss number before you have to figure out which specific activity's loss gets deducted.
So Part 3 gives the total deductible amount for the year. What about the later parts? You mentioned allocation.
Yes, the later parts, Parts 6, 6, 8, and 9X, are all about taking that total allowed loss from Part 3 and distributing it correctly. Part 6 specifically takes the special allowance amount, calculated in Part 2, and allocates it only among those eligible, actively participated rental real estate activities from Part 4. It does this proportionally based on each property's loss.
Okay, divvying up the special allowance first.
Part 7 then deals with any remaining allowed loss. If your total allowed loss in Part 3 was more than just the special allowance, or it allocates the unallowed loss. It spreads the remaining allowed deduction or the total unallowed amount across all your passive activities that had a loss for the year, again, usually on a pro rata basis. This is critical for tracking exactly how much unallowed loss is carried forward for each specific activity.
So Part 7 figures out which activity carries forward how much loss.
Precisely. It ensures your carry-forward amounts are correct for future years and for that eventual disposition. Finally, Parts 8 and 9X are basically reporting schedules. They show the final allowed loss amount for each specific activity and tell you where to report it on your main tax forms, like Schedule C, EF, etc. Part 8 is simpler, used when all the loss from one activity goes onto a single form. Part 9X is used if the loss from one activity needs to be split across multiple forms, like if the disposition involves both ordinary gain loss on Form 4797 and capital gain loss on Form 8949, or if you have specific types of losses like 28% rate capital losses that need separate tracking.
Okay, Parts 8 and 9X are the final output, telling me what number goes where on my actual tax return. So that's the last step then, making sure those allowed loss numbers end up in the right place.
Absolutely critical. Getting numbers off Form 8582 and onto the correct lines of your other tax forms is how you actually realize the tax saving.
Where do they typically go?
For activities reported on Schedule C, Business, Schedule E, Rentals, Partnerships, Schedule F, Farming, or Form 4835 Farm Rental, you'll usually enter the allowed passive loss from Form 8582, Parts 8 or 8AFs, on the line for the net profit or loss of that activity. You should write PAL next to it or in the description. If the activity actually had a net profit for the year, you reduce that profit by the allowed passive loss. For sales of assets or interests reported on Form 478797, business property sales, or Form 8949, capital asset sales, you report any gains as usual. The allowed passive losses related to those sales from Form 8582, Parts 8 or IX are also entered on the appropriate lines. Again, you might note PAL, but remember that special case. If you had an entire disposition of a passive activity with an overall loss, those losses are allowed in full and generally don't even go on Form 8582. You report them directly on Form 4797 or 8949, often marking them EDPA, entire disposition passive activity, to signal why they aren't limited.
Got it. Correct reporting on the final forms is absolutely key to getting the benefit. #outro. Wow, okay. That was an incredibly detailed journey through the world of passive activity losses and Form 8582. It's clear this isn't just some obscure corner of the tax code. It's about real money and smart financial planning. Let's quickly recap the big takeaways for everyone listening. First, PLs are specific limits on losses from activities where you don't materially participate or from most rentals. They're designed to stop tax shelters, but understanding them is really an opportunity for you to optimize.
Mm-hmm.
We learned that proving material participation in a business or qualifying as a real estate professional for your rentals are super powerful ways to make those losses non-passive and fully deductible against any income. Huge potential savings there.
Definitely key strategies.
Even if you don't meet those high bars, that special $25,000 allowance for actively participating in rental real estate can provide significant deductions from many property owners, though watch out for those MGI phase-outs.
Right, crucial for many landlords.
And strategically grouping your activities can simplify participation tests, while properly handling the entire disposition of an activity acts as that crucial release valve, unlocking years of carried forward losses all at once.
That disposition rule is often the end game for PLLs.
Finally, Form 8582, while it looks intimidating, is really just the roadmap. It guides you through consolidating, calculating the limits and allowances, and allocating those losses correctly so you can claim the deductions you're entitled to. It's the tool for navigating these rules for tax optimization.
Well summarized, and I think the final thought to leave listeners with is this. Understanding these passive activity rules isn't just about compliance or filling out a form correctly. It's really about deeply understanding your own financial activities, your businesses, your rentals, your investments, and how your level of involvement directly impacts your tax outcome.
Your involvement drives the tax treatment.
Exactly. It really highlights how being active versus passive isn't just a description. It has real financial consequences and creates real opportunities. So as you head into your next tax season, maybe ask yourself, am I participating enough in my side business to potentially unlock those losses? Am I tracking my time and decisions for my rental property adequately to claim active participation? Or maybe even material participation if I'm close? Are my activities grouped optimally? Or, looking ahead, how can I plan the eventual sale of an activity to best utilize those suspended losses? It shifts the focus from just dealing with passive losses to actively managing your tax situation to achieve savings.
That's a great final thought. It turns it from a limitation into a call for proactive planning and management.
Excellent point. It really encourages you to think strategically about your business structure and your own involvement, knowing it directly impacts your bottom line. Thank you so much for guiding us through this complex topic today.
My pleasure. Hopefully it demystified things a bit. It definitely did for me. And thank you all for joining us on this deep dive. Stay curious, keep asking those big questions, and we'll catch you next time.